Paris, 1720. Wall Street, 1929. The global financial system, 2008. Different centuries, different assets, different institutions. Yet each crisis was built from a remarkably similar sequence. A persuasive new story, expanding credit, rising prices, hidden leverage, and finally, a collapse in confidence. The panic was sudden. The crisis was not. By the end of this video, you will understand the 5 stages that have appeared beneath many of history's major financial crises, and why the most dangerous part of a boom is often the moment when it feels safest. On the surface, these events look unrelated. The Mississippi bubble centered on a trading company tied to French colonial ambitions. The crash of 1929 grew out of a stock market boom, margin lending, and the optimism of the industrial age. The crisis of 2008 began with housing, mortgages, and securities so complex that many professionals struggled to measure the risks inside them. Not every market crash becomes a financial crisis. Not every crisis follows the same script perfectly. History is too complicated for that. But the same ingredients appear often enough to form a recognizable pattern. And the first ingredient is rarely fear. It is hope. Stage 1 is the new story. Many of history's major financial bubbles begin with an idea that is believable, exciting, and partly true. In early 18th century France, the Mississippi Company promised access to the commercial wealth of France's territories in North America and beyond. Its expanding privileges made it look less like an ordinary company and more like the center of a new economic system. In the 1920s, the United States was being transformed by automobiles, electricity, radio, consumer credit, and mass production. The progress was real. It became easy to believe that the old limits of the business cycle had finally been overcome. Before 2008, the story was housing. Home prices had risen for years, mortgages appeared dependable, and the risk of a nationwide decline was widely underestimated. None of these stories was invented from nothing. That is what made them powerful. The strongest financial narratives contain enough truth to make dangerous conclusions feel reasonable. But a story alone cannot create a systemic crisis. It needs fuel. Stage 2 is easy credit. Once enough people believe the story, money begins flowing toward it. John Law's financial system connected the Mississippi Company with a bank that issued paper notes. Company shares, public debt, and the new currency became increasingly intertwined. This allowed financial claims to expand far beyond what a system based only on gold and silver could have supported. In the late 1920s, investors could buy stocks on margin. They paid only part of the price themselves and borrowed the rest, while the shares served as collateral. Before 2008, mortgage credit expanded. Lending standards weakened in many parts of the market, and loans were bundled into securities sold to investors around the world. This is leverage. It sounds technical, but the principle is simple. Borrowed money magnifies gains while prices rise. It also magnifies losses when prices fall. If an investor buys an asset entirely with cash, a small decline is painful. But if the same asset was purchased mostly with borrowed money, that decline can erase the investor's capital and force an immediate sale. Easy credit does more than finance a boom. It accelerates it. More buyers enter. More money competes for the same assets. Prices rise faster, and rising prices begin to change how people think. Stage 3 is when speculation becomes normal. At first, people buy because they believe the story. Later, they believe the story because prices keep rising. The market seems to provide daily proof that the optimists were right. Those who took risks appear intelligent. Those who remained cautious appear to have misunderstood the new world. Lenders loosen standards because recent losses have been small. Institutions create new products to meet demand. Ordinary people watch neighbors and colleagues become wealthier on paper. The fear of losing money is gradually replaced by the fear of missing out. This pressure existed long before social media. In Parisian coffeehouses, American brokerage offices, and suburban property markets, people compared fortunes and wondered why they were still standing outside the opportunity. Then comes the most famous sentence in financial history. Even when the exact words change, this time is different. In 1720, paper credit appeared capable of escaping the old constraints of metallic money. In 1929, a modern industrial economy seemed to have made old cycles obsolete. Before 2008, financial engineering appeared to have spread mortgage risk so widely that no single failure could threaten the system. The explanation changes. The confidence is familiar. Stage 4 is hidden fragility. A financial system can look strongest just as it becomes most vulnerable. Rising asset prices make debts appear safer because the collateral behind them is becoming more valuable. Banks and investors build models based on recent stability. Institutions become connected through loans, securities, guarantees, derivatives, and short-term funding. As long as prices continue rising, the weaknesses remain hidden. In France, the value of Mississippi Company shares, the supply of banknotes, and the government's finances became deeply entangled. In 1929, margin debt connected falling stock prices to forced sales. Yet the stock market crash was not the whole Great Depression. Banking panics beginning in 1930 and spreading afterward turned a severe downturn into a far broader financial and economic collapse. In 2008, mortgages had been packaged into complex securities and distributed throughout the global system. When housing weakened across the United States, losses appeared inside institutions on different continents. The complexity of the network made it difficult to know who was exposed, or which institution could be trusted. Individually, many participants believed they were acting rationally. Collectively, the system depended on one fragile assumption: prices would not fall far enough to break it. Stage 5 is the breaking confidence. The trigger is often mistaken for the cause: a disappointing announcement, a failed institution, a missed payment, or sometimes a modest decline in prices inside a system that has no room left to absorb even a modest decline. In 1720, investors increasingly tried to turn paper wealth into gold and silver. Authorities responded with restrictions and repeated changes to the value of shares and banknotes. Instead of restoring confidence, these measures exposed how dependent the system had become on continued belief in John Law's experiment. In 1929, falling stock prices triggered margin calls. Borrowers had to provide more cash or sell. Forced sales pushed prices lower, creating more margin calls and more selling. In 2008, falling housing prices exposed losses inside mortgage-related securities. Institutions no longer knew which counterparties were safe. Lending froze, collateral values declined, and major failures spread fear through a system built on short-term trust. The sequence becomes self-reinforcing. Falling prices create losses. Losses force sales. Sales push prices lower. Depositors or lenders withdraw. Credit contracts. Businesses and households that were not part of the original speculation lose access to financing. At that point, governments and central banks face an ugly choice. They can allow failures to continue and risk a deeper depression, or they can intervene with liquidity, guarantees, emergency lending, or public funds, stabilizing the system while raising difficult questions about who is protected and what behavior may be encouraged later. There is no cost-free option. Why does this pattern repeat? Because financial innovation changes faster than human behavior. Each generation sees new technology, new assets, and new institutions. The surface looks unfamiliar, so old warnings feel outdated. Profits arrive during the boom, while the punishment comes later. Rising prices reward confidence for years and make skepticism look irrational. Institutions also respond to incentives. Lenders earn fees by lending. Intermediaries earn money by creating and selling financial products. Investors who avoid a booming market may lose clients, status, or opportunity long before caution is proven correct. Memory fades. Incentives remain. The pattern is not evidence of a secret group controlling every crisis. It is the recurring collision of optimism, credit, leverage, and human behavior. Paris in 1720, Wall Street in 1929, New York and London in 2008. Different centuries, different assets, different systems. But in each case, the final panic was sudden, while the crisis had been built slowly. One loan, one rising price, one reassuring assumption at a time. Understanding these 5 stages cannot predict the exact date of a future crisis. That is not the point. The point is to recognize that financial disasters rarely begin when everyone is afraid. They begin when confidence feels justified, caution seems unnecessary, and an entire generation becomes convinced that the old rules no longer apply. The next bubble will not look exactly like the Mississippi Company, the stocks of 1929, or the mortgages of 2008. And that is precisely why intelligent people may once again believe it is different. In the next chapter, we will examine why financial bubbles keep fooling every generation.